Hello, everyone, and welcome to the Pivot Boss Masters core training. And this is the analysis portion for our intraday analysis. And one thing that's really important about intraday analysis is the fact that there are so many different price levels that you can pay attention to on any given day. And what I wanted to do specifically with the core training portion of Masters was to bring to you the key levels that really mean something. Bring to your attention those key levels that the market is really paying attention to, because there are certain price levels that the market pays attention to way more than others. There are certain key levels that will just get hit over and over and over compared to other types of prices. And so these prices that we're going to be looking at directly relate to the auction, the live auction that's going on for any given product. And so that's why it's extremely important to be able to first understand which these prices are, and then understand the games and that traders play around those programs, around those levels. So basically the idea is we're using key levels here that the entire market watches from a professional or institutional perspective. The ones where the algorithms and the programs are deploying these strategies, these systems, after certain market triggers are hit in the market. So if there's some sort of event that occurs off of a pivot, their algorithms and their programs know immediately to perhaps shift bias or change bias into the opposite direction and begin running the stops in the new direction. If the program continues on in the current direction because the trend remains intact, then all counter trend rotations are then defended by the program that is currently controlling that trend. So when you're able to just basically kind of zoom back and just look at which levels are the programs and algos and pros and institutions trading based off of, then it kind of becomes a game of just, okay, these are the collection of tools that they use. Now let's see what's in play today. That's the basic idea. What's in play? Sometimes it's a current price level that the market is trading off of, like the open price. Sometimes it may be an overnight pivot. Sometimes the market is basing its bias off of the midpoint. So just understanding which of these key levels is in play is the biggest hurdle to kind of jump across or jump over. But from there, once you kind of understand the general pattern of how the market plays around these key levels, it becomes apparent that it's that old copy paste that we talked about before. How the programs, algorithms, they basically copy paste their if-then statements, and whatever their approaches or their criteria is for triggering an event, they can copy and paste that to various types of price levels, and that's what we'll be looking at here in intraday analysis. So let's go ahead and begin with core training, intraday analysis for Pivot Boss Masters. So our intraday analysis uses concepts, techniques, and tools that are designed to help us identify the auction's key levels, including pivots, value, acceptance, and rejection. So that's always the biggest thing with regards to analysis, is identifying those key price levels that mean something to the market, right? And so in this case, the must-have tools for intraday analysis and trading are the ones that follow. It's basically the previous high-low close. So this is the previous sessions or previous weeks or months high, low, and close prices. Now, many of you know that I like the RTH high-low close for the intraday, and I like to use the previous weeks and previous months ETH high-low close. So if the high or low or close formed in ETH trading during a week or month, then I'll use those prices as well. So from an RTH perspective, I really believe the RTH works for the most part, because that's what the pros are really looking at. Absolutely, ETH is Globex, extended trading hours. And so I really believe that the pros are the ones that are driving these levels, right? And so certain ones of these are going to be gamed more than others. And I think the previous close, for example, of a day is much more important than the previous close of the RTH or Globex section. And so something like a crude oil, for example, will have much more bounce or reaction at a previous RTH close than just the general session close at the end of the day, 3-something. So from that perspective, RTH for me is for day time frame for the most part, and then from there I'm still trading the ETH charts. I'm still trading those charts, and I'm also trading, the ETH key levels of many of these other patterns. So some of these patterns or some of these levels are from ETH, and some are just RTH. For the most part, the previous high-low close is mostly RTH and day time frame only for me, because I know that's a question that's asked often, so I wanted to cover it a little bit. In terms of the overnight pivot, that's another key level that the market watches. Not many traders know about this pivot, or at least knew about it, but over time it's gotten a lot more coverage. We'll talk a little bit more about the overnight pivot here in a couple of slides. But basically, the overnight pivot is the open price at 3 a.m. Central Time, or 4 a.m. Eastern. So that should read 4 a.m. Eastern. So we'll look a little bit at that as well. The midpoint is basically the high plus low divided by 2 of the current session. And it's the developing midpoint, which means you want to identify the midpoint with every new high or new low that enters the market. So if there's a new high and the same low, then it's going to update that pivot and push the pivot, the midpoint higher. If it's the same high and a new low, then it's going to push that pivot lower. So you want to see the developing midpoint, because this is where you can see a lot more of the action off that level. The volume weighted average price, that's VWAP. This reveals where the average trader bought and sold during the session, thus revealing fair value in real time. This level has been a benchmark for professionals and institutional traders for a very, very long time, for decades. But for some reason, it was hard to come about, getting VWAP for many platforms. And, it took several years. Some platforms had it, but not a lot. And you all know the story of me finally getting fed up at Nirvana and saying, you know what, I'm coding this into my platform. And that's where the Pivot Boss bands were born from. So a super powerful indicator, VWAP, and we'll be looking at that as well. The open price, the RTH open price for a given instrument, obviously this is a very, very important price, because it's basically the starting line. It's the starting line for any given day. And you can also look at the open price for a week or month, or even the open price for the year if you wanted to. But I usually focus on the open of a day. But again, these are prices that can be scalable to any of the time frames that you're looking to trade. But the RTH open is one that, again, the market watches, because that's the starting price. So if the market goes immediately bid at the open, it tells you that bulls are attempting to take control right away of the session and its prices. And so, you start to see how prices are then defended and counter rotations, and how things play off of the open once you see it start to play out. The initial balance, we've seen this one play out great in the Pivot Boss Premium Trading Room over the last couple of weeks, especially in crude oil. The initial balance has been on fire. A first hour range of the RTH session for a given instrument is the initial balance. So it's the first hour high and low. What's the first hour high and what's the first hour low? And this is the first hour of the RTH session. So basically, an RTH open can be different for many different products. The RTH open for crude oil is 8 a.m. Central. The RTH open for the ES is 8:30 a.m. Central. So you have to know which is the RTH open for the product you're trading. And I know, most of you are seasoned pros, so you know this. Some of you are newer to trading futures or just this type of analysis. So it's just important to bring in that very important point that every single product has a different RTH open. So you have to know which RTH open it is for the product you're trading. And then from there, it's just the first hour high and low. That's the initial balance. And from there, you can have so many derivative key levels from that initial balance. Very similar to how we approach Pivot Boss pivots, where we use range expansion targets. That's the same approach with the IB. So you can then create IB expansion targets, 50%, 100% of range in both directions, above IBH and below IBL. You can also have the IB mid, which is the midpoint between the IB high and IB low. So there's a whole lot of different variations to initial balance, and they provide, the reason why it just is so fantastic is because a lot of traders really do use it, and so you get a lot of great self-fulfilling type of trades around those areas. Even when the market is wrong in defending a level, the short squeeze or the long liquidation that usually comes after it is usually still worth trading. So there's a whole lot of great trade ideas and entry opportunities throughout a day that you can trade based off the initial balance. In the footprint chart, this allows you to see real-time order flow via orders that are transacting at the market. So this is hitting the bid versus lifting the offer. That's a very important form of intraday analysis that all traders need to be able to understand how to use, even if you don't use it for scalping or anything like that. It can really help you home in on those areas, those prices that offer razor sharp execution potential in terms of trade location. And when you're able to do that, zoom into a chart and be able to negotiate your way into a trade with very minimal adverse excursion, I mean, that's where things get really powerful for you, because you can use that same technique to enter a scalp, a day trade, a swing trade, a position trade. You can use it to enter so many different ways. So it becomes a great, great form of entry when you're really able to complement it with a footprint chart. The main idea here is you have to know which of these prices are at play. You have to ask yourself every morning which levels are in play today, because for the most part, it's going to be the previous high-low close. That's going to be in play early and after hours and early in RTH. The open price is going to be a big-time factor when the market opens. Volume-weighted average price is going to be very important if there's a significant slope to the day, so if prices are trending up or down. So each of these will be in play on certain days, and sometimes they won't be in play. So it's up to you to be able to understand which of these key levels is in play, and then from there understand how to trade your way around them using a lot of the basis for what we do here, basically understanding and identifying rejection and shaking prices from under or overvalued situations back to value. Let's see, a question here. Frank, are you looking at the futures time or the times of the underlying assets? For example, the day index starts at 9 for European time, but the futures are trading from 8. So what time will the IB be? So I would say it's the RTH open time. So for example, the the ES futures will trade overnight, but during the RTH, when it opens at 8:30 is when the IB starts. So even though the futures are trading overnight, the initial balance wouldn't be until 8:30 to 9:30. So in your example, because I haven't traded the DAX, it's been a while. So in your example, it would be the 9 o'clock European time, if that's the RTH open, like if that's the pit open or whatever it would be. With regards to some of these, there's some leeway, in terms of IB. In terms of, we'll talk more about this as we go on, but in terms of IB, I've also made mention that I trade a 2-hour initial balance for currency futures, so I'll be trading 6E or 6J or 6B, and I would just sit there and trade a 2-hour initial balance from 2 to 4 a.m. And that's 2 to 4 a.m. Central Time, and that's a 2-hour initial balance window, and then from there I start engaging it after 4 a.m., and from there it's fantastic. So there is some leeway there. I would say the biggest thing with regards to initial balance, and again, we'll get to this tomorrow, because we're going to break this up into 2 segments. Today we're going to talk about previous high-low close, overnight pivot, midpoint, and volume-weighted average price, and tomorrow we'll finish up with open price, initial balance, and footprint. But the biggest thing with regards to initial balance, at least in my opinion, is that the initial balance, you want it to be created during a period of time where the market is actively seeking its range, right? And so that's what's important about the open. The open is a time when the market's auctioning higher or lower to find that high and find that low and find the range for the day, right? And so, if there's a wave of momentum that happens at a certain time in a certain product at a given time every single day, then that's the wave that you can use. And that's why I said about the currency futures. I noticed a wave from 2 to 4 a.m. that if you put the initial balance around that wave in the currency futures, you still have a great viable initial balance, even though the definition is for a 1-hour range. So there's always some flexibility there. And that's what I would caution with any of this analysis, anything in general, is that you can feel free to be creative and create your own edge and identify, because it's all about tendencies and behaviors and understanding that those patterns that happen around these levels. And that's how I was able to come up with most of the stuff that I'm talking about here, just understanding the tendencies and behaviors of these things. So basically, when it comes all down to it, we have to just know what's in play. And once we know what's in play, then we know how to engage that key level. So volume weighted average price, or VWAP, reveals where the average trader bought and sold during the session, thus revealing fair value in real time. VWAP has been used as an industry benchmark for professionals, by professionals for a long time, and is estimated to be used in upwards of 90% of active algorithms. And so this is what I mentioned before. I got a little bit annoyed when I worked back at Nirvana because I'd been asking for a VWAP indicator for some time, and it wasn't getting built. And it's just how it is with any platform, right? You want your tool, you want it now, and there really weren't many tools at the time that had VWAP as a base calculation. Over the past several years, you've seen it come online much, much more, but back, say 6 or 8 or even 10 years ago, it wasn't as widely available unless you were using a pro style platform. So, in wanting to have something now on my machine, I developed it really quickly, and you can see the calculation isn't that bad, right? This isn't a big deal. So that's the calculation or the formula for VWAP, and it's basically, if you just kind of bring it down into kind of a normal English, it would be the number of shares bought times the share price divided by the total shares bought throughout the day since the open or since the beginning of whatever period of time you're looking at. That's kind of just a base idea. So it's basically the sum of the shares bought times the share price divided by total shares bought. So, and the thing with VWAP is that for those of you that understand VWAP, if you have a day that starts right here, so this is the close of the previous day, and then you start to tick here, right? VWAP starts beginning with the first tick of the new session. It starts to create right there. And then from there, VWAP just starts to quietly build, depending upon which way it's going. And then wherever VWAP ends the day, it is basically what you could call a VWAP pivot. We're not going to be talking about those much now, but you'll see some of that in later courses and chart galleries with regards to our master's education. But I just wanted to show that a VWAP pivot is very important as well, and it's the final closing value of VWAP for any given session. So if it's a day VWAP and it closes right here, that's where VWAP's final value is. The upcoming day, that VWAP is now a pivot for fair value in the upcoming day. So very similar to how you would look at the pivot range. We studied the pivot range in pivot-based analysis. If you have a VWAP closing pivot that is constantly seeing higher and higher closes, you have an uptrend, and pullbacks to it should be defended. Pullbacks to it, right? And so, VWAP is a clear idea of value in any chart. It just gives you a clear idea of where value is in a chart. And so if you're looking at a day VWAP, you can see where it is, right? Where's VWAP? And then when price closes the day, now that's a closing value of VWAP. So it gives you a real-time and static view of VWAP. And that's fantastic because this is just a little part of history right here that says, hey, that was VWAP the last day. So if you're trending up and price comes back to value, this is an area to defend, right? If you're trending down and you have VWAP pivots, then obviously you're looking to sell in the downtrend. With regards to VWAP, everything can kind of be shown right here off of the VWAP matrix. And VWAP matrix basically shows you the rules of engagement for using VWAP, right? And this is basically the general approach to using VWAP. And it's trade slope. And that's what this all kind of boils down to. If you have a bullish slope, if VWAP has a bullish slope, look to buy dips at VWAP, right? Look to buy dips. And so right here, it's saying buy if prices are below VWAP. Then that gives you a profitable trade. So if you have an uptrending market and prices are below VWAP, the outcome is a profitable trade. Boom, right? Now it says here, sell sell above VWAP, right? So if you're in an uptrending market and prices like this, then you'd be looking to sell up here above value and bring it back to value, right? So that's where you have the sell above value, gets you a profitable trade. On the flip side here, if you're trending down, right, trending down, and here's a little move right there. So you're looking to sell above VWAP again, right? In a downtrending market, that's here, 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 in a downtrending market. And then, of course, aggressive buying is seen when it's counterintuitive. So if you're like this and VWAP is trending up, by selling here, you're basically aggressive selling. You're trying to say that value does not represent the current market opinion, and now you're being an aggressive seller, an initiative seller. And so this is basically the VWAP matrix that you can use when you're looking at VWAP just to decide, okay, VWAP is currently trending up and it's below VWAP. Is it a good trade? Yes, it is. Or VWAP is trending down and it's above VWAP. Is it a good trade? Yes, it is. You know, that's generally the idea. There's also ideas where the slope is basically flat. When the slope is flat of VWAP, you're basically looking to fade the edges, right? And additionally, when the slope is flat, I would also say look to fade the edges and just look to fade new highs and new lows. Because, you know, you'll see the expanding ripple effect where things are doing this, right? And so you don't want to get caught trying to sell here because it's going to run your stop, right? Or selling, you know, here. You have to wait for those new highs, wait for those new lows, because those are the ones that are rejected back toward VWAP and across the range. So VWAP has been a big time part of my trading for a long time. Again, ever since I was able to put it on my charts and just see the value of VWAP, you know, just like I did with the pivot range, and I mentioned that before. Once I was able to get it on my charts and see the lower time frames and the higher time frames and see how price reacted to it, it was a no-brainer to keep it on the charts. It's just something that pros pay attention to. It's again, my initial research with regards to programs and algorithms estimated that upwards of 90% of these algorithms that engage the market include VWAP as one of their primary inputs. That's a huge deal. That's huge. If that's happening, then that means that we need to be having it on our machine as well. The other thing I'll mention about VWAP is that at times prices, you know, most traders have VWAP as just a daily indicator. So just an indicator that's just shown for one day. But in some of the indicators that are more advanced, like the one I created for profit bands for Nirvana, allows you to create a user-defined boundary so that you can create a one-day VWAP, or you can create a two-day VWAP, or a three-day VWAP, or a five-day VWAP, or you can do a one-week VWAP, or a two-week VWAP, or a four-week VWAP, or a three-month VWAP, right? And once you're able to do that, especially with the way that my approach calculates it, you know, you really get some fantastic higher time frame moves off of it, because that's where really I think things open up, because everybody understands how important VWAP is in a lower time frame. But when you're able to open it up to the higher time frames, you get the same type of reactions off of VWAP, but they're just bigger moves. And most people aren't seeing those moves because they don't have VWAPs to calculate those higher time frames. So if we're able to put it on our charts and see the higher time frame VWAPs, it makes things much more powerful for us. So using bands, like use 1 standard deviation, 2 standard deviation as edges, or wait till it forms. That's a great question with regards to fade the edges. You know, if you have standard deviation on there, like the Pivot Boss bands, for example, or another version of VWAP bands, then that's the best way to approach looking for fading opportunities. Because especially if you're able to quantify that it's a 1 standard deviation range or 2 standard deviation range, then it helps you kind of home in on those areas where prices are likely to reject. But I don't think a standard deviation is necessary at times, because that's why I say fade new highs and fade new lows, because you're not really looking for a range so much as you're just looking for the stops to get run beyond the prior pivot. We'll look at some examples of that in a moment. So the basic idea is just trade the slope. Bullish slope, look to buy dips. Bearish slope, look to sell rips. A flat slope is a trading range market. And then a change of bias, and this is important with every single one of these key pivots we're looking at, is a change of bias. When does the market shift from a buy-side bias to a sell-side bias? When do the algos shift their bias? And there are certain tells that we can look at with regards to these, which we'll see a couple of instances of in the charts. Before we jump into the charts, I wanted to show one last quick slide here, and this one basically deals with the overnight pivot and the trading, the developing midpoint. So algos and programs tend to use prices that are easily derived, like the developing midpoint, which is nothing more than the day's midpoint, and the overnight pivot, which is nothing more than the 3 a.m. price central time. And basically that's all they use sometimes. They're just these easy key pivots. And from there, they have their if then else statements that they tag along to that pivot, and from there they allow the algos and the programs to trade as they will. And so by studying these pivots, you can basically get advance notice the next time these buy or sell programs are going to kick off, which is going to spark the next major momentum move once those stops are triggered. And so that's the idea, is being able to use some of these levels to ID, first of all, when the programs are engaging them, and then number two, once you understand that they're engaging these levels, how do you ride alongside those programs and ride the coattails of momentum that they bring? So number one, the overnight algo pivot is simply the price of a given market at 3 a.m. Central Time or 4 a.m. Eastern. This pivot is also known as the European algo pivot, which refers to the fact that the European professionals and institutions execute programs based off of this pivot. And so this pivot, was really, for me at least, introduced to me in the Mr. Top Step room. And so one of the traders in the room is an algo developer based off of his Fibonacci data, and name is Sam Easley, actually. And he actually introduced me to the overnight pivot and talked about it often in the room. And as is customary in the Pivot Boss manner, you take a key data point that you're introduced to, and then you run it through a whole lot of simulations and data, and you look to see if that pivot has edge. And then from there, you look to engage that pivot in much the same way we engage any of the other key levels. And from there, you can see, does it have value or does it not have value? And from what I've come across, the overnight pivot has a ton of value. And basically, the idea is that the European markets will tend to open at 2 a.m., right? And at 3 a.m. is when the initial balance is in, for the most part, right? From 2 to 3 a.m., the first hour high and low. And so whatever price the market is trading at, 1 hour into the market, that's where a lot of the European professionals and institutions will then begin to, their programs will begin to use that new 3 a.m. pivot as the pivot for the day. Sometimes this pivot is major in play, sometimes it's not. But for the most part, this pivot is definitely something that can be super useful in the charts, because when it is in play, it offers razor sharp opportunities, high accuracy opportunities, mainly because those algos are trading off of it. So you're seeing perfect rejections off that level, or you're seeing multiple defenses at that level before a stops run happens. That's the type of behavior you want to see. That's what I mean where I say that the market pays attention to certain prices way more than it does others. This is one of those key levels that the market pays attention to. When buyers and sellers are defending current, some sort of pivot, and they're defending, and a stop run occurs against those positions, that's when the market is watching those levels. And so, the overnight pivot has a whole lot of backing with regards to being something that I really believe in. In terms of trading the overnight pivot, there are certain things you want to look for. And right here you see if the overnight pivot is bid, so say 3 a.m. comes and right away the overnight pivot goes bid. And if there's a big move that happens right away, it doesn't even go against it. It's just boom, it's bid and it goes up the first retest is usually defended. So the first retest, whether it happens 20 or 30 minutes later or whether it happens 3 hours later, usually the first retest is defended. And that could be an area also where counterparties will look to run the stops of those defending that level. So that retest always has a lot of great eyeballs on it. If the overnight pivot is offered, then look to defend the first retest as well. So again, if the overnight pivot is immediately offered and price sells off, the first retest, whether it happens 30 minutes later or 3 hours later, likely to be defended again. And that could continue to be the pace throughout the day as the overnight pivot continues to be defended and defended and defended until proven otherwise. If the overnight pivot is chopped, so if price opens around the overnight pivot and then price just goes up and then quickly back below it and then quickly back above it, then beware, because you could be witnessing the development of an expansion ripple. And that's the algo ripple effect that we talked about before, where price will gyrate up and down around the pivot. So if you have a pivot right here, the algo ripple effect says that price goes up a little, then down a little, then up a little to run the stops, then down a little to run the stops, and up a little, then down a little, right? And you keep doing this until you see some sort of move that comes from it. And so with any of these pivots, again, whether it's the overnight pivot, whether it's the open price, any of these pivots, if you see price start to do the ripple effect around it, you got to back out. You got to be careful because it's whipsaw city. You got to look to fade the edges if you want to engage, because fading the edges is a great way to trade the algo ripple. And you pretty much have a pretty good idea that it's going to ripple out immediately upon price going up a little, down a little, up. And then right about there, okay, you know what? I think we're about to do this, Jazz. And there's always variations of what happens. But just understanding the ripple, because this isn't so much one of those ideas that you can make money from so much as it is an idea that you can save money from. If you can understand when this is about to happen, you won't get whipsawed every time price is at one of these extremes. And as a matter of fact, you may switch your bias to be fading extremes and actually make money. So, in the premium trading room, we're pretty good about identifying that ripple right away and then getting us on the right side of not being whipsawed and perhaps fading new highs, new lows. And again, the change of bias here, you got to look for signs of a shift in bias. And each of these indicators are the same thing as all of them are. And real quickly here, finally, before we jump into some charts, the developing midpoint, the mid simply displays the current developing midpoint of the session, which can be calculated in ETH or RTH. So just like you can have an ETH VWAP or an RTH VWAP, you can have an ETH mid and an RTH mid. And basically the midpoint is just the highest high plus the lowest low. So the highest high plus the lowest low divided by 2. And that gives you, your developing midpoint. So if price opens up here and drops here, you have this high and this low, and you have a midpoint right here. But say price comes down to here, right? Then the midpoint drops a little, right? Drops. And then it does this, and then price will go up, right? And so the developing midpoint is very important. It's not just the high plus low plus close, and then there's the midpoint, and it's static. It's important that you have the developing so that you see every single ebb and flow throughout the day. And so the midpoint here is another simple level, and again, the algorithms clearly use this pivot to establish buy and sell bias on any given day. And a change in bias is often very evident using the midpoint as well. As a matter of fact, the midpoint is one of those first indicators where I started to really reveal the hidden algo tendencies at a pivot was using the midpoint, because it was so simple, but you could see it so clearly. And just being able to see that tendency and then translating that tendency over to other price levels that we're looking at it works really, really well. So here we have, lastly, if you're looking to trade the mid, it's the bullish slope, bearish slope, flat slope, and change of bias. And that's the same thing that we looked at with regards to VWAP. So with regards to VWAP, if it's sloping to the upside, look to defend it. on counter trend rotations, that's the same thing with the mid. And you can see the same thing across the way from bearish slope to selling the rips in a strong bearish trendy market. And if it's flat, the mid is flat, then watch it fade the edges. But keep an eye on a change of bias, because when a change of bias occurs around the midpoint or based off of the midpoint, I think the stops run can be incredible. So you have to watch it closely. Okay, let's go ahead and take a look at some of the charts right now. So I'm going to go over here to the Masters Lookbooks and click this link. And again, right now there's 8 charts in here. I'm going to go with the first one up here. And this one is volume weighted average price. And the idea behind this chart here is, what I wanted to do was just kind of show you the tendencies that the algos kind of have and kind of give you the 1 through 5 of it all. Basically, you have ETH VWAP starts printing right here. There's a little blue dot. So as soon as the first bars come online, the blue dot starts to update, and you can see it updates the rest of the day and starts to go throughout like this, and then it moves higher like this, and then here's where it ends the day. Okay, so that's ETH VWAP. If this was RTH VWAP, you'd see 830 about right here, and then RTH VWAP would start, going from here. So number one is, typically speaking, when a market opens in overnight trading, what you're looking for is the impulse move. What's the impulse move? It's find that high, find that low. Where's the rejection points happening? And you can see in this case, price opened up above the previous session's closing value and rallied first. Then it pulled back below VWAP and saw some buying. But right here, that's a lower high. You see that little lower high? And that little lower high right there means something to the algorithms. Typically speaking, the algorithms will watch that right there, and immediately when that lower high is seen right there, the algorithms will shift their bias to a sell-side bias. And now once that happens and price is successful in pushing below the previous pivot low, all successive counter trend rotations now are defended by the sell programs until something triggers a change of bias event. So basically right here you're seeing failed new high, and that's after the initial impulse move up. And that shifts the algos to a sell side bias. And when this sell side bias pushes price successfully through that recent low and new lows are reached, then every rotation then is defended and price rotates lower and lower. So what I was doing here was just basically showing you with these little red call outs here where the algos are then stepping on the gas again, because it's almost like a car. You drive, you push the pedal down, you drive, you let go of the pedal, and it kind of it slows down. Then you get to a spot where you want to push to get fast again, and boom, you step on the gas and it goes. Then you let off the pedal, then you step on the gas, then you let off the pedal, then you step off the gas, right? And so that's what happens with these algorithms and now every counter trend rotation is going to be defended at VWAP until there is basically some trigger that changes the bias. And right here, that's the trigger, that little box right there. And basically what happens is, after this higher low or lower high right here, price finds new lows, pulls back to VWAP and is defended, and then right here it fails to make a new low below that previous low. This is where the change of bias starts to occur, because once the programs see that that's a failed new low, there's almost immediately a quick run back up to sucker in last minute sellers, because these sellers right here got in, and you can see how price moved away. You can see how price started to push down right here. And then whoever didn't get filled is like, oh, I wish price would come back. That was such a great move. So price does come back. And they're like, yeah, let's get in. And then price gets in, and right there, this is where they step on the gas with buy programs. So buy programs begin to squeeze the late sellers right here upon a retest of this failed new low. And that's a tip. That's a tip that the programs have shifted now to a buy-side bias. And that's when you see stops get run right through VWAP. Now right here, there's a little tiny ball right there. That little tiny ball right there shows you that at the very end, even after the squeeze, some sellers were still wanting to get in. So you see a little red candle there and you see a rejection. There was still a last minute, these buy programs were still absorbing at the last minute, and by absorbing those last minute sellers at VWAP, it was providing a little extra fuel to provide a squeeze. And so you can see how many times prices came into VWAP but began to get absorbed here after a failed new low. Once that happened here, all of the stops came out here. So right there. So on this candle right here, that's where the buy programs step on the gas and they run the stops at the late trapped sellers and anyone who has been short all morning. So all the stops above here get run. Not only that, on every counter trend rotation now you have buy programs coming in to defend. And so you see this thing just kind of unleash. The change of bias occurs right here and it's complete. But this is what I wanted to make mention of, because this is the same type of if-then-else statement that you'll see on any one of these pivots, whether it's the mid, whether it's VWAP, whether it's the overnight pivot, previous high-low close. Some of those, they'll all have similar types of tendencies. But the thing that's most important is that you'll have a sell-side bias that's controlling until you get a failed new high or new low. And so right here, this sell program comes down, you get a failed new low, and at this point is when they begin to shift bias. So it's not here when the stops come out where the change of bias has occurred. That's the completion of the changeover of bias. This is now when it's full on in effect. It starts here, and then they get them up a little bit to fuel up a little bit more, and then right here is where they really begin to squeeze. So they get them short again. So this is a little bit here where they're goading them into that sell, and then they get them right there and trap. And then up here, that's when they squeeze it. So it's happening way, way earlier. And so in order to identify, when this type of opportunity can happen, it's mostly about looking at the current existing trend and then watching those edges. Are new participants that are defending that trend getting paid? If not, you could see a huge squeeze in the opposite direction. So this was just a little something here to kind of show what happens around here at these key levels. So this is volume weighted average price with regards to the ripple, the algo ripple effect. And so the algo ripple, again, this is what I mentioned before. It's, you have two phases. One where you have a pivot and you get the expanding ripple, which is the phase where the algos are trying to generate movement, by subtly getting this thing to go back and forth and rock the stops on either side. And then you have the reverse, which is the contracting pivot, where you get the impulse back here and then it begins to coil around that pivot, coil until finally it takes it bid or offered. And so this is one of those cases where the market just coiled perfectly right into the pivots, and the pivot being ETH and RTH VWAP. So what I wanted to show here was basically first you have RTH VWAP here, ETH VWAP here. So this light cyan colored line or dotted line right here started here. And that's your 830 bar. Over here, this is the overnight start, and you can see, they just kind of trade on throughout the day. So with regards to ETH versus RTH, I typically like to trade ETH VWAP. But you also have to know that ETH VWAP will, be in play earlier in the day, and then after the normalization, the initial normalization of VWAP comes online for the RTH version, then you'll see the RTH become more in play later on in the morning. And sometimes they are right in stride and they provide great confluence like you see here. Nice confluence as this thing just coiled perfectly around it and then the stops came out. So the first thing is just the ripple. Understanding when you're seeing a ripple, either a contracting or expanding ripple, because you're either about to see a whipsaw activity. So an expanding ripple implies whipsaw, right? So fade the new highs, fade new lows. And then a contracting ripple implies future expansion. So one is whipsaws and one's expansion, so you got to know which one's which, right? And so this one's pretty easy. We get the expansion. So the ripple, okay? If the market is flat, note that VWAP is flat, indicating a trading range market. So right here you can see the trap. The trap is, this is the trap. Because again, this is the contracting ripple. So this one is designed to get a lot of traders in here. A lot of traders, and then they pull the volatility and just kind of quiet up. So this is where they're building fuel, right? It's designed to entice traders to enter the market. Eventually, one side or the other will get their stops run. And then once the fuel is released, you get the squeeze. And this squeeze right here, this is where the stops come out. Major squeeze comes out of there. A big buy imbalance comes up here. Or sorry, a big imbalance. I don't know if it's a buy imbalance. If that's a sell imbalance, it's perfect. Because then if those sellers don't get paid, then they can help fuel this. If it's a buy imbalance, you got to be careful. But anytime you squeeze out of a ripple effect like this and push through recent highs, you're usually going to see a confirmed move in that direction. So once the squeeze is on, the buy program stepped on the gas right here, and you can see the big squeeze occur. And now all counter trend rotations are then defended by the programs on the way up until proven otherwise. Here's an expanding ripple right here. So this one's just a very quick slide here again. What does an expanding ripple look like? Here's VWAP. That's the start of ETH VWAP. You can see it push up, then a push down. Then a push up, barely pushing beyond those highs, and then down, pushing out those lows. Then come up a little bit, then take out these lows. Then push up and pull back. Then push up a little bit and take out those highs and pull back, right? And then you got to take out these highs and these. So you can see that it's a very difficult time to trade. This isn't a perfectly symmetrical ripple, and it's never going to be perfect in these markets, right? Sometimes you're going to have great patterns. Sometimes it's going to look like this. But if you understand that this thing's rippling around, you can then look to only engage new highs or new lows and look to fade just those opportunities instead of getting chopped up in the mess. So basically, expanding ripples, they imply that the market is trying to generate some fuel here as they entice market participants to enter the market. And then the stops are run in either direction until it finally has an impulse range large enough to either see some directional conviction, or then perhaps a reverse coil occurs. And now you do this until you see expansion. So, just understanding this, again, this isn't a money-making opportunity so much as it's a money-saving opportunity. And then from there, if you're able to identify that, I need to be fading highs and lows, I think that's where you can also profit from something like this. So you want to avoid the whipsaws and focus on fading new highs or new lows if you have to engage that market. So here's some more with VWAP. With regards to VWAP, there's ETH VWAP and there's RTH VWAP, right? And VWAP, regardless of which calculation, needs a little bit of time for normalization, right? So here is when price opens up after hours, and you can see VWAP trading, and it's a little box around there. Here's the open price. You can see VWAP trading a little bit, but it's not really useful. It's not really useful. So you have to know, regardless of the calculation you're using, whether it's ETH or RTH, you can't just start trading VWAP, 2 minutes after it starts to print. It takes sometimes 30 minutes at least 30 minutes for it to start normalizing. That's why I say that since ETH VWAP is in play from the previous session's close, it's usually going to be in play earlier in the day. So which VWAP is in play? Well, ETH VWAP will likely be in play earlier in the day, and RTH VWAP will shine later on in the morning. So here it is right here where, this one is still trying to normalize after opening, the RTH VWAP. Meanwhile, the ETH VWAP has a great slope to it with a downtrending market. The first retest offers a great selling opportunity for new lows. And then when price bounces into VWAP the next time around, doesn't quite get to the ETH version, but does get to the RTH version. Perfect retest, and again, another sell-off to new lows. So Sometimes it's important to pull up an RTH versus ETH VWAP just to see if there's any significant pockets, because the VWAP pocket will tell you, especially when a market is trending up or down, will tell you where market participants are likely to engage that market to defend counter trend rotations. So you want to look to defend the VWAP pocket when the levels are sloped and stacked. So basically, in this case, they're sloped to the downside and they're stacked one on top of each other. Pullback or rotations into that VWAP pocket should be defended for a continuation downward. But by no means am I saying that you must plot both VWAPs. You do not have to plot both VWAPs. I usually plot ETH VWAP only, and if I'm curious, I pop up the RTH version. So up here on this chart, for example, here's ETH. That little button's RTH, so I can pop this one up and this one comes up, and if I'm curious, I hit that button and this one pops up. Then if there's nothing doing, I hit that button again and it drops off. So the ability to have them both at your disposal is very, very nice. It's a nice luxury to have, but it is by no means necessary to have both VWAPs up. I think you can get all the trading opportunities that you can want by trading one of these VWAPs only, but again, if you want to look for additional opportunities, then trading based off of both can be just fine. The other thing to consider is that when ETH and RTH form confluence, it's a good opportunity. It really is, especially in a sloped environment. So you can see right here, ETH and RTH VWAP almost one and the same. So when price comes back toward that area, it makes for a nice buying opportunity late in the day. And that is late in the day, in the last hour and a half of the session. So, moves can turn out very, very nicely even later on in the day. At times also, which I didn't put in this slide here, when price gets too far away from its value, you can see this move and it gets too far away and you see the distance between VWAP and that low. When that becomes too great, typically speaking, you're looking for rotations back toward value. And so when price formed a failed lower low here and couldn't go anymore, the expectation was that price may come back to value, and that's what you saw here late in the day. All right, so here's some more on volume weighted average price. I want to start from left to right for a moment. Right here, this is something that I talked about just a moment ago when we were on the slides, when I mentioned that when you see market participants defending a level, defending, and then the stops come out, that tells you that the market is watching that level. That validates that level. So when the market is defending any type of level, you know that level has bearing in the market, because that's what the market is trading. Remember, the market is going to trade those price levels that mean the most to that product's current auction. And that's why it's important that we trade the prices we do, whether it's previous high-low close, the open, volume weighted average price, the mid, overnight pivot. Those types of key levels are the ones that the market trades. So I've highlighted a couple of these again because, it's not just about one type of setup that happens off of these. It's basically just being able to identify all the various scenarios that's happening. So on any given day, you know how to engage it. And so from over here, from this perspective here, you can see in this little box, there's a rotation here, a rotation here, a rotation here. And those are all sellers that are selling VWAP. Right? VWAP was sloping downward, and those sellers were defending, and they were putting their stops here, their buy stops, right? And so on these rotations, this is what we just talked about. Look at that rotation. It comes down here, and there's a failed new low. So then price comes up here, and then it comes down, another failed new low, right? And then boom, price goes through here and runs the stops to the upside. A big-time push. And then later on, the first rotation to a confluence zone is defended, and then you see a rally. Okay? So this is a time right here when the market is defending a level, and then they fail to see any movement in their direction, and their stops get run. But it all starts off of a failed new low. That was a higher low right there, and it could not go. And again, the programs had already shifted bias perhaps here, and then ran the stops using that one as well. So a very nice move there. Confluence after change of bias. So this is an important concept. You see it twice. You see it twice on this one chart in 3 days. but basically confluence after change in bias occurs when there is a shift in bias here because prices were trending downward, failed new low, and then here the market goes from a sell bias to a buy side bias. So a confluence after a change of bias. So the first retest of VWAP after a change of bias happens to have RTH and ETH confluence. That makes for high odds up trade opportunity. So if the market, after changing bias to the buy side, comes back, then right here, with that confluence, offers a great buying opportunity. Here's a change in bias where prices were being bid, and then it couldn't go. Once the sell-off change of bias occurred, the first retest at the confluence zone of RTH and ETH VWAP is defended. High opportunity trade right there. So again, sometimes it doesn't have to be the home run trade. It never has to be the home run trade. It just has to be the one that has the highest odds for winning. After a change of bias, this trade can be very, very high odds. Change of bias, high odds trade. When VWAP is sloping perfectly in one direction or another, high odds trades defending the direction of that trend. When there's a market that's constantly one participant or another defending the level, yet they're not getting paid, watch for the stops to come out. Those are just basic tendencies and pattern behaviors that happen over and over again with all of these various pivots. Would you set a limit order above VWAP for a long in anticipation of a stop run after a failed new low? So there's a lot of ways to engage that. That's a great question, and we'll talk about some entry techniques later on in the week as well. But you know, the earliest idea is somewhere on the squeeze portion, you know, somewhere right here. Because when you start to get the failed low here and you bounce and come, you know, there's a sense where you already know, okay, there's a squeeze portion coming. You know, when I'm looking for it because I anticipate it every time, you can see this squeeze coming. You know it's coming. So the idea for me would be to get in somewhere on this leg ahead of the test, and then get in ahead of the squeeze. But you could use also a stop market order and stop into the trade if you wanted to. So, you know, put a you know, basically get filled with the other stops that are going to get run. And there's basically retests that you can do after a push up and a retest. So there's various entry opportunities that you can do. But I think the best idea is that if you think there's a higher low going on and we may see a stops run, then get in on the leg down here ahead of that move. I've always thought about if I'm trying to break through, you know, this resistance up here, I don't want to trade it at the resistance. I want to trade it before the resistance to give it some momentum into that level. And so that's the idea here. I'd like to be in somewhere on this leg squeezing up, or look for the first pullback afterward. So here's another one with volume weighted average price. And this one is your basic compression leads to expansion. And again, this one has a rounded bottom in it, which we know to be very, very powerful. And so here's a rounded bottom that formed in crude oil. This one deals with VWAP, but also kind of how it fits in with other patterns that form. And so VWAP here was very flat, very, very flat on this day. I mean, look, that's a horizontal line. You can't even see it there. That's about as flat as it gets. And so when VWAP starts to become very, very flat, and you can see price is not really getting any mustard above or below it, it's a trading range market. It's a trading range market. And so when the market gets into a trading range phase, especially with regards to VWAP, you want to be able to watch for rotations at the edge of the range if you must trade it. You know, so at the edge of this range, you know, you're looking to fade back up, perhaps fade back down, you know, if you can find where the edge is. But there's other times where you just want to be paying attention to who's getting paid and who's not getting paid. And that's what a rounded bottom does for me. A rounded bottom tells me who's not getting paid. Because when you've been in a downtrending market here, you were seeing new lows, new lows, new lows, and then all of a sudden you couldn't get a new low. Then you auction higher to try and entice some sellers. Then you come back down and you can't get a new low. You auction higher to entice sellers. You push down and you can't get a new low. And now all of those sellers that are coming in aren't getting paid. As a matter of fact, they're getting higher and higher lows, right? So that right there around VWAP tells you, hey, be watching out for a potential transition from a trading range market to perhaps a markup phase. And especially when you have this rounded bottom, this is a pattern that you need to be watching for each and every time. It doesn't always form, but you know when it forms. You know when it forms. It takes some time to develop, but in the time that it takes to develop this pattern, it's building the energy required or necessary for this type of move, right? It's the mini accumulation phase ahead of the markup phase. And so with regards to VWAP, if it's super flat, you need to be looking to either stay on the sideline or fade new highs and new lows. But you also need to be watching for any signs of bias. Because if there's a bias that starts to develop, then it could provide a solid move. And then from there, VWAP will start to trend up, and then you're looking to defend pullbacks in a sloping environment. So once the stops come out right here, that's where the stops came out. Buy programs came and defended every counter trend rotation. And we saw this one play out live as well. And we were talking about looking for bulls to defend LVNs on the way up. And that's basically what happened. Here's the overnight algo pivot. So the overnight algo pivot is, again, the 3 a.m. Central pivot or 4 a.m. Eastern. And it's basically the open price at 3 a.m. And one thing that I always mention is that I'm using volume bars here. So, sometimes these volume bars are independent of time, so it may not be a perfect, 3 a.m. open. So sometimes my overnight pivot might be a tick or two off. Sometimes it's perfectly on. In order to get the right overnight pivot, then you need to be in a time-based chart, or you can just tell your program just to give you the open price at 3 a.m. for that, for that price bar. So 3 a.m. is a very good open. And this is a case where we had the expanding ripple. And so this is one where you can see often, because since it is 3 a.m. Central, I'm not usually up trading at that time. So by the time I come into the market, it'll be anywhere between 4:30 and 6 a.m., somewhere in that zone, usually around 5 that I'm looking at it. And so I've had some time to see it trade around overnight VPOC or overnight pivot. Did it go immediately offered? Did it go immediately bid? Or did it chop around it? That's what I'm looking for. Which one of those did it do? Is it immediately bid, immediately offered, or chop? And in this case, you can see it was chop. Down, then up, then down, then up, then down, then up, then down, then up. And so you could see it just came and just ran the stops either way. And so when you can notice that price is expanding or rippling around the pivot, you either stand aside and wait for it to juice up enough to get some expansion, or you look to fade the extremes. And so in this case right here, we saw price go offered through the recent lows. It ran the stops. The first pullback was defended, also off of a key level, 44s. And then we saw every single pullback get defended as this thing continued downward. And so this goes back to the point here that for some of you that have been with me a long time, we talked about the opening range, for example, the opening 30-minute range of the market, for example, where there's an opening range for the pivot as well, the overnight pivot. And if there's an opening range, a 30-minute opening range that creates around the pivot, or maybe even an hour, watching for breakouts from that range could be very, very fruitful, because eventually you see, this type of move. The price discovery will continue trending downward until you see the impulse range develop that basically sets the tone for new creation of value. And so that's one thing I'm always looking for, is that prices, once they're in a price discovery phase and they're trending, they're going to stop going down whenever you find a low, bounce and find a high, and then now you're going to set that edge. And so that's what this is basically. Prices found a pullback high, slammed down, and bounced back up. And once that happened, you found that impulse range, and now you have boundaries to trade off of. Let's see here. A couple of good questions coming through. What is a volume bar chart? So a volume bar chart basically is this bar right here, where each bar is a certain amount of contracts or volume. So every single one of these bars has 1,000 contracts of volume for crude oil. So every single bar has the same amount of volume. So if I put up the volume down here at the bottom of the chart, where you would normally have volume, every single one would be the same size because they'd all be 1,000. And basically after 1,000 contracts fills up a bar, you start the next bar. And so volume bars, if you go back and look at the algorithmic and program analysis discussion that we did, which I believe is day 2 of last week, it talks a little bit more about volume bars and why they're important. For the most part, it's mainly because volume bars allow you to see the signatures that the programs and the algos leave behind much easier or much more easily than in a time-based bar. So, for example, this type of great movement you're seeing right here, if you put this on a 5-minute chart, you're probably not going to see those ebbs and flows as nicely. So a volume bar chart, range bar chart, tick bar chart, those are all non-time based charts. And so you're able to see program type of movement and signatures in those time frames a lot easier. With regards to time-based, not so much. So do you plan to resurrect opening range discussion? I do, yeah. I mean, opening range is a good concept that a lot of traders use. The Swing Trade Pro talks about some opening range entry style techniques. So if you go back to the dashboard and look at the Swing Trade Pro, there's some opening range concepts in there. But I would like to provide an opening range discussion as well. Usually I like to provide more discussions about things that some traders really haven't been exposed to as much. Opening range, a lot of folks talk about it, but I think it's still one of those concepts that's very good to know about. And my buddy Jeff Bish over at Market Gauge wrote the book on it too. Very good. So in terms of the 1,000 volume bar chart, any specific reason why I chose it? Each contract will have its own periodicity that I like to use. For this one, I like to see the ebbs and flows somewhere between a 1 and 3 minute chart usually, but just know that volume bar charts develop quicker or slower depending upon the volatility. So if this is a high volatility market, you can see here from 8 o'clock to 9 o'clock, high volatility market, and look how many bars formed during that period of time, right? And then you look from 9 o'clock to 10, it's a different amount of bars that form during this time. And then you look at, from the previous session's close up to 8 o'clock, it's this amount of bars. So, depending upon when or what type of volatility you're seeing in the market, these bars will form faster or slower. I generally like to see about a 1 to 3 minute bar form in terms of duration, but it's going to change. So that's my execution time frame. So there's execution time frames, and then if I want to see a higher time frame, I can do 2,500, 5,000, something like that. The NQ, CL, and Gold, I all use 1,000 for those. And then for the ES, I use a 5,000. Those are my execution time frames. For the ES, I'll go to 10,000, 20,000 to look at higher time frame charts. Do I put any value on COT reports in my trading? I do not. That doesn't mean that they are not useful. That just means I don't use them for what I'm doing. So intraday analysis also talks about the previous high-low close, which we really haven't talked about that much in this particular training here, because we have a great course called Professional Price Levels at the archived Core Masters dashboard there. So that has a whole lot of great training with regards to the previous high-low close. What I wanted to make mention of, with at least from this perspective in this snap chart here, is that the previous high-low close of a market gives you those raw prices of the auction, right? That's what it is. That's all it is. Previous high-low close. Those are the raw prices of the auction that the market is trading at that particular time. And so when you leave behind the previous high-low close, depending upon where you close in relation to the high or low, that's typically telling you who or which market participants are going to engage and what their attempt is going to be in terms of price movement. And so right here, You can see this is the previous week's high, is this one. This is the previous week's close, and this is the previous week's low. So to begin the week, price closed here, and it drops down to the low. And right away, if you drop to the low, the primary idea to begin the week, if you test the low, the primary idea, especially if you've been trending up, is to defend and trap bears at or below the previous low and return price to the previous high. That's the primary idea. That's your blueprint, if you will. In this case, the early move worked out okay and then failed. And then price comes back down, and now it's trying to hold below the previous week's low again, and again fails. This time, bulls were able to successfully squeeze those bears into the previous week's high. So that's pretty much the move. So the idea behind this slide is to show you all that really when it comes down to a pro style of analyzing the market at times, it's just about the primary move of the market. What's the primary move of the market going to be? Because the primary move of the market from a week-to-week basis is based off the previous week's high-low close. And so if we're closing near these lows down here in an uptrending market, the first pullback is likely to be defended for a new high, right? Well, this is it. This is your pullback, and that's the move. So bulls want to get that move, or they're trying to get this move. The rest, it's done. By that time, it's done. And we're just chopping around the previous high, and we're doing nothing that rest of that week. The move was all done right here. That was the move to be in, and this was the move to be not in. Over here, the same thing happens. So now price closes near the highs after the recent move. So the first move above the previous week's high is a call to action for bears looking to trap those bulls. And if they're successful in trapping, their goal is by the end of the week to get it all the way back to the previous week's low. That's the idea, right? And so in this case, they successfully trapped, price dropped down, and then all rotations the next several days off of the previous week's close and just above were all defended and defended and defended, and that was absorption until finally the stops came out and basically price dropped into the target. Now, the price did not hit the previous week's low perfectly, but just know it doesn't have to be perfect. It never has to be perfect. Your idea was that, hey, if this is a trap and now they're defending and absorbing, maybe I can get this to here. And now you're trying to capture one of these moves, right? And so the main idea behind this is just to show you that, you know, when you map out these key levels on your charts, when you map them out and see, okay, where is price right now? Where's it closing the week in relation to, you know, the overall trend and what's going on with the upcoming week's, you know, key levels? It can tell you right away, are bears going to look to trap right away? Are bulls looking to trap right away? And then that can tell you which side is likely to be the ones who are looking to influence that move. But just very, very evident back-to-back weeks that this was the crown jewel of each of those moves. That's what you're looking to do. As a trader, as a pro, you're trying to see, okay, can I take it from a rejection back to a prior period of resistance or support? Can I take it from rejection back down across? And so, you know, this is a great, great example, and it just occurred over the last couple of weeks. So here's the overnight pivot in the ES. Unlike VWAP, unlike the midpoint, this one does not dynamically update throughout the day. What's the 3 a.m. open? And put a line there until the next 3 a.m. open. Here's a 3 a.m. open. Put a line there until the next 3 a.m. open. Here's one, right? And so this is what I mentioned before. A couple of the tendencies that we look for. Number one, we look to see is it offered or bid right away, right? And so here's a couple of scenarios here where here's a 3 a.m. open and price immediately goes bid. Immediately goes bid. You see, there's 3 a.m., tried for a second, and just immediately goes up. So that's what I mentioned. If the overnight pivot is immediately bid, then retests are likely to be defended until proven otherwise. This is what I mentioned before, that the overnight pivot can have such extreme precision because it's such an algo-centric key level. It's not the previous high, lower close, right? It's not VWAP. It's not, some of these other midpoint. It is the European algo pivot, right? It is a very important pivot at times that the market just trades off of. And so again, when it goes back to that slide where we're talking about how to engage the overnight pivot, number one, if the overnight pivot is bid, look to defend the first retest. If it pays, look to defend the second retest. If it pays again, whatever the case may be. In this case right here, it went bid immediately and never came back. This one went offered immediately, so the retests defended. Retests defended. Wasn't perfect, but you can see, the tendency there. If I scroll back a little bit more here, here's a couple where price chopped around. So you can see right here, look, there's the overnight pivot. A little above, a little below. A little above, a little below. A little below, a little below. When it starts to do that, back off the pivot. Back off the pivot, because now this is an expanding ripple. They all look a little different, but you can see how it went up, down, then up and down, then up and down, up and down, then up, down, right? And so this can be detrimental to your health trading something like that. So you just have to understand, okay, is it bid right away or is it offered right away? And then sometimes when price chops around it, it'll create a very nice range that you can actually then see a breakout from. For example, right here, look at how price just chopped above, back and forth. Stops came out, big time move. Here's another case right here, expanding ripple. Here's the pivot, and it just goes up and down, up and down, up and down, up and down. How many times will that save you stop losses and getting, wiggled out of trades because they're coming and gaming the stops on both sides? When I noticed that tendency, it opened up a whole new world of me not getting frustrated after a couple of tries in here saying, oh man, they're not going anywhere. Just looking at that ripple is very important. This is the NQ. Go here, 25,000. This is what I mentioned before with regards to forming a tiny range around it. So right here, I talked about before, if you watch the overnight pivot here, and you can calculate the formation of a range around that level where it just kind of chops back and forth, eventually a breakout from that range can be fantastic. So I've actually created a range that actually identifies a range like this, and then we'll look to find sell opportunities through it or fade opportunities back within it. And again, this is the type of range I was talking about, where if it just chops, eventually one of the sides or the other is going to get their stops run. Right here, look at the expanding ripple. Right? I mean, just knowing a couple of these tendencies is very, very powerful, I think, at least, because I'm able to then not be able to get into the trade and not get stopped out and squeezed and whipsawed and the whole thing. Crude oil is probably one of those markets where I've seen the biggest reaction to some of these overnight pivot moves. I mean, they're just really, really nice. Sometimes, I mean, it's just uncanny. But you can see how it can become a key level just throughout the day and just become something where it chops here, then tries to go back, then it goes up, then it comes back. So anytime price gets too far away from the overnight pivot, if it's in a range, larger overnight range or some kind of a bigger range, 5-day range, I mean, it'll come right back to the pivot more often than not. Just like value, just like, VWAP, for example. Yeah, a lot of great examples in here where you can just see how prices trades off of it. Here's it going bid, then defending, and squeezing. Very nice. I wanted to check out one last thing here. I know we didn't look at too much of the mid here, so let me just pop up a mid. So the midpoint, everything I said with regards to the overnight pivot, very much the same with the midpoint. I love the midpoint when it starts to get unidirectionally, strong one way or another. Here you can see just up and down and up, and right when price came back above. So here's the impulse move, right? Impulse low, impulse high. It came back, sealed the midpoint. And what do we know about a midpoint? Where it comes back, it hits the midpoint, it immediately starts to turn. That usually tells you you're headed for the opposite end. And then boom, the stops come out and it continues. But that was all based off of the midpoint right there. You didn't really need much else to really look at other than that. The other thing that we'll talk about later on, so for the most part, we're doing a great introduction here with regards to some of these key levels. We'll see more tomorrow. But down the road, we'll also talk about something else that I love to implement, which is the midpoint range. So the midpoint range is something that you can pop up. You can double click your mid in market delta and pop up the bands. So it's a midpoint range or midpoint bands where you can pop up above and below. So when price gets just to it, sometimes it'll get just to here and rally, or sometimes it'll go just below and rally. It gives you an additional kind of like a pivot-like type range to watch out for as well. And we'll look at some of those examples down the road. But I love the midpoint as well. One of those ones where when you see a shift in bias, you really start to see it, how the stops come out because of some tool like this. For example, right here is a great one where you can see it. Basically, prices selling off, low comes back up. Here's a failed new low. Here's the run, and that's the change of bias. Boom. Then it pulls back. Here's a defense and a change of bias. So when midpoint is stair-stepping higher, like the stairs, taking the stairs up, you want to defend pullbacks to the staircase, right? If you look to the left over here, you can see how it becomes clear resistance after an early sell-off to begin the overnight session. A big sell-off, price comes back to it, defends. The midpoint just becomes a clear level to watch. Time and time again, you can just see every single day there's some sort of great test off of that level. And again, sometimes the best levels occur after a change of bias. So prices are, for example, holding up here, right? They're holding, they fail to hold there, and when you change bias, the first retest is defended. If that's successful, the second retest is defended, right? And so many times, again, after a change of bias, those first retests become very, very high probability opportunities to trade. Can I write code for the developing midpoint for Thinkorswim? I will. I attempted to do it before, and it wasn't plotting the way I expected. It was supposed to take a second, and it didn't. And then I didn't get back to the project. So I'll definitely get a developing midpoint going for Thinkorswim. Absolutely. So that pretty much does it for the first part of our intraday analysis. This was core training for our intraday analysis regarding volume weighted average price, the midpoint, the overnight pivot, and the previous high-low close. Again, if you want more information regarding the previous high-low close and some of the blueprint trades that you can trade based off of those key levels, you can come over here to the Masters Lookbooks. And once it pops that up, you can come down here to professional price levels. Click on that. You see 28 charts here. So there's 28 charts, 2 pages worth, where you're going to get some fantastic charts here that are just going to explain all of the various levels that are in play on a given day and what bulls and bears are looking to do at those various levels. So you can flip all the way through these levels and really get a great idea of the types of games that the buyers and sellers play at these various levels. So a lot of great content here. Again, that's why I didn't talk a whole lot about pro price levels, because we already have a lot of this already up here. In addition, the initial balance, for those of you that want to learn more about the initial balance, there's also in this presentation as well range extensions. So a lot of great charts here to further study. In addition to what we just talked about with regards to intraday analysis. So I would ask that you go over there, check it out, and let me know what you think about those training materials. We're going to continue to put up more charts annotated for each of these topics, so expect more midpoint, more overnight pivot, more VWAP charts to go up in the Masters Lookbook chart gallery, in addition to the upcoming topics that we'll see in part 2 of intraday analysis, which will be the footprint in addition to the open price and the initial balance with extension. So again, thank you all for hanging out for core training, the analysis portion for intraday analysis. Again, thank you all for being a great audience, and I look forward to seeing you all soon. Take care and trade well.